Hello traders, it's 8:02 a.m. Chicago time on Wednesday the 14th of February 2018. It's Valentine's Day and the market is showing the sellers some love here on the CPI. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The market is in a tizzy right now. That's probably the most technical way I can describe it. The driver here is a very, very important release that we've been waiting for all week. The January CPI came in higher than consensus. The expectation was for 0.5% versus 0.3%. What does that mean macroeconomically? You'll see a lot of movement in the dollar, in the treasuries, very currency sensitive, interest rate sensitive products because interest rates, CPIs are higher, which gives more room to the Fed to move upwards in interest rates, which of course dampens the economy and that prices for borrowing go up. Now, if you remember about a week ago, maybe a week and a half, I don't remember, I did a Trader Bite where I talked about the yield curve versus the S&P going back to 1990 maybe. And what this is likely to do is it's likely to push the short end of the yield curve higher, causing more flattening in the curve overall. And so that's why the market responded so aggressively. The SOC here is 2674 in the S&P. We'll go over that in a minute. It's on your flex levels. 2674 is the scene of the crime. This is the point at which the normal auction got interrupted and the market sold off. So 2674 down to 2627. Pretty big move. So 47 points, I think. Yeah, it's about 47 points happening within about 15 minutes. Pretty decent move for the pre-market. So this is likely to be an engaging day, although we are back in yesterday's range in the S&P. So looking at the quote board, gold is up, of course. The yen is up. The dollar's up. Anything that's dollar dependent is going to be down. The correlation is inverted. These are crude oil. Things like crude oil, gasoline, and so on are going to take a bit of a hit as the dollar strengthens on the market's anticipation that interest rates would be higher because CPI is higher. Retail sales also came out disappointing, down 0.3% versus up 0.2% expected. Retail sales ex autos came in at 0 versus 0.5 again. Not as important as CPI, but that's what we've got. For today, looking ahead, we still have business inventories at 10 Eastern for December, expecting 0.3. And then we get crude oil inventories at 10:30 Eastern, expecting a surplus of 3 million. Distillate inventories expecting a zero change. And gasoline expecting a surplus of 1.6 million. Again, crude is trading at 58.61, down 1%, down 1% on the March crude futures. Okay, so that's where we are. Now, a quick question. I know there's a delay to the broadcast here of about 7 to 20 seconds. A quick vote for those of you who want to vote in the chat box here, in the YouTube chat box, the live stream box. Does it make sense to continue looking at the prior day's action? This is something that I do anyway. Does it make sense to take up the 6 or 8 minutes to go over what the plan was for the prior day? Is it useful to you, or is it something that I can do away with and just get into what we saw, what we expect, and so on, so we can shorten this broadcast? I'd like to get it down to 10 or max 15 minutes. Here's where we are. Okay, here's where we were yesterday. The both hypotheses or both scenarios yesterday were bullish. I didn't cover. I had two bullish, one sideways, and two bearish scenarios. They don't always work out that way. They don't work out that way. So it's to me yesterday I was looking for a response down, any response down, and I'm looking to buy it. I'm looking for that impulse up. I'm looking for the market to push into the prior day's high. That was the key. Trade idea of the day. That's what ended up working out. However, I expected it to dip a little bit too much here. But again, this is just a guess, right? Well, all we're doing is taking as best as we can, taking a guess as to where it might turn. The actual the actual turn takes place, of course, on Bookmap or some area that we're looking to lean against. So prior week's close, blah, blah, blah. Any area we're looking for a reaction, we'll call that a decision or stock zone. And then we look for the market to respond there, take the trade, and then manage the trade based on the scenario. And the scenario was up. Okay. Secondary scenario was for it to push up early, push through the prior day's high, and then fail back over to consolidate in the MC point of control, 2642 or so. In either case, I was looking higher into the session. Here's what actually happened. Here's what actually happened. We went sideways. The other thing that I talked about, and I hope you picked up, was that I was expecting sideways compressed movement yesterday. There's a very quick drop in the overall range and in the volume overnight. The warning that I tried to put out there, that I did put out there, I don't like using the word tried when it comes to trading. The warning I put out there is that we're likely to see two-way trading, short-term traders in control, and then we're looking for that impulse up. This is the impulse up I was talking about right here. But it's a grind all the way through. Once it put in a low, crossed back over, we know we have an open auction. Both sides are active, and now we know the mid is no good to us when it comes to where it stands. So the context is we're an open auction, we're in value. The mid is not something you want to trade against in that situation. It's likely to crisscross. Once it broke out, I did not, honestly, I did not catch this big rip up here. It was more outside in trading in this area here. Any new pop was sold and so on. That's what outside in trading is, or other people call it mean reversion trading. So until this happens, so I expect at some point to take a loss as the market breaks, and then we put in a double distribution profile. Love double distribution profiles for the simple reason that we have a very clearly defined rejection zone in a double distribution. So what we have almost is like 2 days of trading. Market balanced down here at like these prices, and then it broke through and it bounced up here, and then with a clear low volume node. The low volume node corresponds very cleanly with the prior day's point of control. Essentially what this has done is it has squeezed a lot of the participation that occurred, the short time frame participation that has occurred the day before. Those got pushed, and then the point of control became a support base for the trade going forward. So with a double distribution, what we know is as long as it does not get through this 54, 55 area, it's more of a zone than a single price. As long as it doesn't get through, then we're expecting it to bounce back and push down. If it gets through, then we're expecting it to pull back and then target 62 as the point of control. So what the market does is it moves from low volume node to high volume node, and then if there's enough selling, we don't know if there will be, it starts to move back down to the low volume node. But if it finds that sellers are not motivated, then it'll likely make gun for this low volume node. It tests a low volume node to see what kind of interest there is in sellers. If it pushes through the low volume node, then it's likely to pull back. This is our opportunity, and then we go to the point of control, the high volume node of the next distribution. That's why I like them. Clearly defined risk. Sometimes it can chop through. Sometimes it can build a high volume node in between the distributions on the following day. We'll see what today does. So that's what we did yesterday. Here's what we did since then. To continue our review portion, I switched here to a 4-tick Renko because to trade the CPI release. Here's what we did overnight. This is again a 4-tick Renko, very, very compressed. So the entire overnight session shows up as this. Okay, so from about 3:30 Central, 4:30 Eastern, all the way to 7:30 a.m. That's as much as we did on a Renko chart. Remember, a bar's not printed unless we have movement in a Renko, and that's why I use them for triggers. And then from 7:30 onwards, so for the last 45 minutes, this is what we did. A lot of volatility, a lot of movement. The volume is four times the expected, the normal amount statistically. It is twice yesterday. It is a little bit higher than the prior 2 days, and it's almost as high as the big sell-off day. So a lot of participation in this number today, and you could see that the SOC was way up here. I marked it on the flex levels right up here. This is where this auction got interrupted. So this auction was very orderly. We had a push overnight. We were trading sideways, anticipating the number. And then the auction got interrupted at the CPI release to the downside. We dropped, like I said, 47 points. 47 points, and now we're making our way back to VWAP and the mid of the session. Very clear break. Very clear break away, and we have a high, low volume, very deep, low volume node zone going on here. With multiple distributions. So we have multiple high volume node distributions. So there's a lot for the market to work with, to repair, or whatever. And so it's the expectation here is that it's likely to drift, to continue to drift up. Quite an intense reaction. It's building a channel upwards. I expect it to continue to drift up into the low volume node. Why? Because it is inside of yesterday's range, and it's likely to regain the prior value. Okay, so what are we looking for today? Today we're looking for OTF involvement, which means that you're to expect participation to be relatively aggressive. I'm expecting volume to continue to be relatively high. I'm expecting maneuvering to take place across pretty much all the futures markets, because this does have a wide impact, or could potentially have a wide impact on prices, and the market's task is to revalue price when there's a change, and there has been a change. Currently, the market's trading in the point of control. Here's the point of control, the black line. This comes from way over here. This is the point of control of the entire trading, or the entire auction, since the sell-off day of last Monday, the 5th. Okay, so we are, despite the big drop, we are actually in balance. The bigger picture, we are back in balance. And so overall, the market's expected to open up, and I'm expecting wide swings. I'm expecting the market to try to retest lower as we open up. I'm looking for At some point, as it advertises lower, I'm looking for a buy response. A buy response to push us back up, but I'm expecting it to chop on the open. I'm looking for a drop. The probability of any particular scenario to play out today is really it's all up in the air. Once the OTF starts to act, it's one of those things where you have to wait for the market to wait to see what the market will do before you start to step in. And so I'm looking for it to retest the impulse down and then come back up and then push back into value. I expect that 26.53 through 55 will likely behave as resistance on a first test, right? And the first key target and fail. So if we push into this, I expect this to fail on the first go. That gives us around 30 points of range or so for today. That's the primary idea. So I'm looking for how does the market open and respond on the open? Is it trading crisscrossing across the opening price? Is it extending the opening swing up and down? And then and on which side does it break? So there's nothing for me to do. I have to sit and be patient and wait until we see an impulse one way or the other. And we judge the impulse based on the size of the rotation, the delta, what goes into that rotation. Then we start to push in that direction until the market says enough. Okay, so that's the expectation, the primary expectation. The secondary expectation is to open, test lower, push through yesterday's low, and then find buyers just like we did on this number, get back up into 26.43, 45, and then continue higher. Continue higher into 54. So on the scenario, we expect the primary push to be an open test drive down or an open rejection reverse down. So we expect an early impulse down and a grind up. Okay, that's the second scenario. The tertiary scenario is we push higher early. We get into the 50, 26, 50 or so, 46 to 50, and then we just grind out and then we start to fail through, in which case I expect us to have a small continuation and then the threat will be to the overnight low. Unfortunately, it's hard for me to say I don't know what the OTF will do here. The OTF is the third force in the market. It's highly unpredictable. So we'll see how that plays out. This is another day where your job is to sit and wait. To sit and wait and be patient. FOMO, if there was a FOMO meter, it'll be very, very high today. In anticipation of continued activity like we had before. The VIX currently, the VIX yesterday closed at about 25. We expect that to pop up a little bit, but not very much. I don't expect that premiums would rise too dramatically. But we'll see. As the VIX pushes up, of course, we start to look for fear in the market as people are paying higher insurance for their option positions. So we'll see how that works out. In any case, pay attention to what it's doing and pay attention to your response to what it's doing. It's really important for you to be engaged with, okay, am I getting anxious? Am I feeling like I'm missing these moves? Just relax. You only need a professional trader really makes their money throughout the year on 1,000 trades. You make the biggest money on maybe 30 or 40 of them. You don't make big money on 1,000 trades. You need to select your spots, and that's your job. That's what you have to do. Good luck.